Dominique Moerenhout. You are Chief Executive Officer at the European Public Real Estate Association. Thank you for joining us on BiTV.
Yeah, thanks very much, Luc, for having me again today here.
We are just at the beginning of August, and most listed property groups have now disclosed their H1 results. After a year of rising interest rates, inflation, let's say macroeconomic tensions across the board, how have European REITs been affected by this macroeconomic tension, as I said, and the turmoil of the recent months?
Yeah, so before jumping into 2023, let's first remember that the year 2022 has also been a tough year for both the listed and unlisted real estate sector, affected primarily by a soaring inflation across Europe, rising interest rates, the war in Ukraine, some geopolitical tensions across the world. The listed real estate sector in Europe suffered a 37% negative return last year, creating, in our view, an unjustified dislocation between the listed and unlisted sector. Coming back on your question regarding the H1 results in the listed sector for 2023, indeed, most listed companies have now published their results, excluding the large German residential companies, which I can't comment on so far because they haven't published yet, at least as we speak here today. Overall, the results continue to demonstrate a very strong operational performance, which is in total disconnect with a share price still trading at, on average across Europe, at the 45% discount to NAV. If we look a little bit closer at the results, so what do they tell us? So first of all, the rental growth still benefits from indexation, but is expected to normalize as the indexation effect is likely to peak this year. Occupancy overall has improved, the earnings per share beat the consensus, valuations declined, but will obviously decline further in the next months. The good news is probably that the European listed real estate sector is back in positive territory in 2023. With a total return of 0.6% as per the 31st of July, so a few days ago, opening the door to some cautious optimism, which contrasts with additional pressure on the unlisted real estate sector, where, as an example, the largest French asset manager announced last week a 13 to 17% share price reduction in some of its vehicles.
In terms of, let's say, sectors and geographies, are some asset classes, some sub-markets proving more resilient than others in these results for H1 2023?
Yeah, first of all, in terms of geographies, the most performing countries this year have been France, the Netherlands, and in Switzerland, which really contrast with a 1.4% total return for the UK, and also with the Nordics suffering more in 2023. As far as the subsectors are concerned, retail and lodging are strong outperforming this year, and we are very happy to see the retail sector back in very positive terms this year, because they've been also penalized over the last years by a lot of investors, but it's not the case anymore. If there is definitely one sector where we see some optimism coming back, where we also see transactions happening, is definitely in the retail sector. The industrial sector has also performed okay so far this year. Office also delivers a positive return of 1.7% since the beginning of this year, which confirms that the European office sector can't be compared with the US. Across Europe, people are back to the office. It's not the case in the US yet, and I think the US will probably struggle a bit more than Europe from that point of view. So what's happening in the US is not mirrored in the European market so far, and I don't think it will even be in the years to come. Healthcare sector across Europe is unfortunately also more under pressure this year, particularly with operators in Germany and in France.
Okay, so we have a let's say contrasted picture with some positive, some maybe more negative indications from the first half of the year. As we look forward later in the year and we come back from hopefully sunny vacations in September. At the beginning of September, I remind everyone that EPRA will be hosting its annual conference from the September 5th to 7th in London. So as I said, as we look forward towards the end of 2023, maybe what are some areas of tensions, maybe some point of interest that investors and analysts should be looking at, or maybe more should be looking out for in the second half of the year?
Yeah, maybe if I make the allusion about the holiday and the weather, I think the real estate sector is a little bit like the weather we are experiencing. In my case, in Belgium, for the time being, is that sometimes you have to be a little bit patient and hope that the sun will come back. But I'm a positive guy, and I know the sun is coming back in a few days from now here in Belgium. So now coming back, I would say more concretely on your question. Everybody, first of all, expected the real estate sector to bounce back in the Q2 2023, but it didn't happen yet, as interest rates have not stabilized. I'm a strong believer that markets will only really recover when interest rates will stabilize and when valuation will settle, which, as far as we see in the reserves, as far as what we see in the direct markets, I would say valuation have not settled yet. We see some changes in valuation across the spectrum between 1 to 5 to 6% big max, but we were expecting further declines in valuation. Also, if you look at the transaction market so far, so the wait and see approach is also settled for longer than initially anticipated. Transaction volumes across Europe and across sectors are historically very low, still demonstrating a probable 15 to 20% price gap between what buyers are eager to put on the table to make a deal and what sellers are eager to accept. If I look at investors in the listed real estate space, since the beginning of the year, we can say that they are strategically positive on the sector, but tactically cautious. Equity is definitely available on the market, available to be deployed, and some investors started reinvesting in the listed real estate sector, to the exception of Asian and US investors. When you look at where the sector is today, when you look at the results, and we are, I would say, of the opinion that timing is right for investors to redeploy capital into the European listed real estate sector for various reasons. First of all, is that the listed real estate sector always tends to outperform in a period following high inflation rate and low economic growth, which is exactly the scenario where we navigate in for the time being. Secondly, the listed real estate sector is also very well positioned from a balance sheet to cope with rising interest rates. On average, 85% is a fixed rate debt in our sector. The average duration is around 6 years. The LTV stands at 37%, and financing costs are just over 2%. So those are the first two arguments. The two other arguments I could think of is that the discount to NAV is today at an historical level of 45% across Europe, very similar to the situation we experienced post GFC, at which time the rebound was spectacular. And also, last but not least, we have some research for the time being predicting that listed should outperform the unlisted sector in the next 5 years. So all in all, a cautious optimism for the moment.
Thank you very much, Dominique Moerenhout, for this very valuable insight. We will see you early September, September 5th to 7th in London for EPRA's annual conference. In the meantime, thank you for being with us on BiTV, and also thank you all for joining us. We'll see you soon on BiTV.